Okay, we're diving deep today. Our mission is to really break down the core investment thinking of Ray Dalio. Specifically, how he suggests protecting and growing wealth when interest rates are just stuck so low. Cash used to feel safe, right?
Mm.
But now, maybe it's actually kind of risky.
That's exactly it. That's the core challenge. And look, this discussion comes straight from his recent talks with, serious investors all over the world.
Right.
We're in a time where those old, reliable fixed income strategies, they're really struggling.
Mm.
It's forcing everyone, big institutions, individual learners like you listening, to rethink what a stable portfolio even looks like anymore.
And it's a massive issue. You can see it in how institutions are reacting. Like Bridgewater's commitment in China is huge.
Well, absolutely huge.
Yeah.
Our sources point this out. Their funds issued right there in China, over 60 billion RMB.
60 billion.
Yeah. And that number, it just shows this massive local hunger for, well, professional asset allocation help. Because the old rules,
Yeah.
they just aren't working the same way.
Makes sense.
When your safe returns are near zero and things feel volatile, investors get desperate for, like, a system, discipline, a framework that actually works no matter what the economy is doing. Dalio offers that.
Okay, let's jump straight into maybe his biggest warning. The one that should, frankly, worry anyone just hoarding cash. Dalio says it straight. From a long-term perspective, cash is a very poor investment.
Yeah. And he's not just being dramatic, it's backed by history.
Uh-huh.
I mean, think about it. Ever since the U.S. dollar came off the gold standard, what, 1971?
Yep, 71.
Its actual buying power has just cratered, dropped by over 85%. So if you had, say, $100 back then and just kept it as cash,
Yeah.
today it buys you maybe $15 worth of stuff.
$15, wow.
Inflation really is that quiet killer of wealth. It just eats away at it.
So if cash is that bad, what about bonds? I mean, that's always been the traditional safe haven, hasn't it?
Well, that's the problem now. The risk in cash bleeds right over into bonds when yields are this low. Look at the actual numbers. Take China's 10-year government bond yield.
Mm-hmm.
When it's under 3% historically, the average return you get over the next 3 years, it's only about 2.1% per year.
2.1%. That barely keeps up with inflation. If it even does, you're essentially treading water.
Exactly. And here's the key thing for you to grasp, the so what of it all. At these low rates, your potential bond returns depend mostly on prices going up, meaning yields have to fall even further, not on getting steady coupon payments.
Ah, okay. So you're betting on rates dropping more, which is risky in itself.
Highly risky. You're exposed to sudden interest rate spikes, wiping out your capital.
Okay, so if bonds are iffy and cash is, as you said, inflationary poison,
Yeah.
how do we actually build something stable? This must bring us to his big idea, the all-weather strategy.
Yes, precisely. And the beauty of all weather, it isn't about predicting what's next. It's built to survive whatever comes next. It tries to achieve that stability by balancing assets across 4 different economic scenarios,
Right, the 4 quadrants, like
Yeah.
rising inflation, falling inflation, growth higher than expected, growth lower than expected.
Those 4.
What's really cool is the math behind it, this idea of risk parity. It's not just owning a bit of everything, is it?
Yeah.
He talks about finding 15 or fewer uncorrelated return streams. Why that number? Why uncorrelated?
Well, that's as close as you get to a free lunch in finance, really. Think of it like a really sophisticated insurance policy.
Yeah.
If one part of your portfolio gets hit hard because, say, inflation spikes, another part is designed to actually gain value from that same event because they don't move together. They're uncorrelated. And modern portfolio theory, the math behind it, it shows that if you combine, say, 10 to 15 of these low correlation assets,
Yeah.
you can slash the overall risk, the volatility of your portfolio by a huge amount, like 60 to 80%,
Huh?
while aiming for roughly the same expected return.
60 to 80% reduction in risk. That's
Yeah.
massive. And you mentioned China earlier. This isn't just theory, right? We've seen it work.
Oh, yeah, absolutely. Real world proof.
Yeah.
Bridgewater's all-weather fund in China,
Hmm.
it averaged about 16% a year over a 6-year period.
16%. That's
Mhm.
impressive.
Very. But here's the crucial part for stability. Its worst single year. It was still only down between 10% and 14%. Way, way better than the local stock markets, which bounced around a lot more wildly. It shows that stability in action.
Okay, so that's the design of the portfolio. Let's shift gears a bit to managing it because, even the best plan can fall apart if the person running it makes emotional mistakes. What's the biggest danger here?
Oh, easily emotion.
Yeah.
Human behavior. That's why the absolute bedrock of Dalio's advice is systematic rebalancing. It's the mechanism, the discipline you need to keep that risk profile you designed, and it forces you to do something that feels totally wrong.
Which is,
Selling the stuff that's done really well, your winners, And buying more of the stuff that's done poorly, you're losers.
Yeah, that's tough. I know personally, selling something that's going up feels like you're leaving money on the table. It fights your instincts.
It does. And that's exactly why it works, because it forces discipline over instinct. And the data backs it up. Backtesting shows that just doing a simple annual rebalance can actually boost your yearly returns by maybe 0.5% to 1%.
Just from rebalancing.
Yeah, and it can cut your portfolio risk by another 10–15%. And get this, about 70% of that extra return comes just from enforcing that consistent behavior, taking the emotion out.
So that mechanical discipline, it's basically designed to stop us from making the classic mistake, trying to time the market. How bad is that mistake for the average person?
It's really bad. Costs them a lot. There's research, the Dalio analysis is famous for this. It shows regular investors lose something like 1.5% to 2% in returns every single year.
Just from bad timing.
Just from trying to jump in and out.
You bet.
Buying high when things feel good and selling low when they get scared. It's classic behavioral finance, overconfidence, fear. Systematic rebalancing is like the automated cure for that.
Okay, so if the aim is balance, not trying to guess the future, then diversifying geographically seems like a key tool. You don't need to predict which country wins, you just need exposure to different places.
Exactly right. Geographic diversification lets you spread your bets across different economic cycles, different government policies, different realities on the ground. And if you just look at valuations right now, you see why it makes sense. There are clear differences, like the U.S. stock market. Its PE ratio is pretty high, historically speaking, around 22 times earnings. That's like the 80th percentile.
Pretty expensive then, relative to history.
Yeah, suggesting a lot of good news is already baked in. But then you look somewhere else, say China A shares, their PE is more like 14 times. That's closer to the 40th percentile historically.
So a potentially better entry point, relatively speaking.
Potentially. It's not about predicting which one will outperform next year. It's about acknowledging these valuation differences exist and using them to balance your portfolio globally. Strip the risk instead of putting all your eggs in one potentially expensive basket.
We've hit on internal discipline. Now, what about those big external forces Dalio talks about? Specifically, the risks from all this global debt. I mean, U.S. federal debt alone is, what, over $35 trillion now? That's like 130% of GDP. How does he suggest hedging against that kind of structural risk we can't control?
Well, that sheer level of debt inevitably puts pressure on the world's main reserve currency, right? The US dollar. And we're actually seeing clear evidence of a shift, maybe towards a more multipolar money system. The dollar share of global reserves held by central banks, it's fallen quite a bit. It was maybe 72% back in 2000.
Right.
And projections put it around 58% by 2025. That kind of vulnerability makes holding hard assets really important.
And that's where gold comes in, playing its classic role as sort of currency insurance.
Absolutely. Dalio literally calls gold the second largest reserve currency in the world.
Yeah.
And you see central banks, especially in Asia, acting on this concern. They're buying gold. China's central bank, for instance. Gold is now up to about 4.2% of their total foreign reserves. It's a signal they're diversifying away from pure fiat currency risk.
And it's a good diversifier for portfolios too, right? Because it often moves differently from stocks.
Exactly. That low correlation is key. Gold's long-term return, say over 20 years, is actually pretty decent, around 8.5% a year. But his main job in a portfolio like this is stability. Its correlation to stocks over the long run is tiny, like 0.1. So when stocks or bonds are under stress, gold often acts as that stabilizing counterweight.
Okay, let's quickly touch on the new kid on the block, Bitcoin. Often pitched as a diversifier, but that volatility is just, wow.
It is extreme. Bitcoin's annualized volatility, it can be over 80%. That's like 4 or 5 times more volatile than global stocks. Now, Dalio acknowledges it exists, says he owns a tiny bit himself, but he definitely prefers gold because it's been accepted by institutions for centuries. So for you, the learner, the practical advice is usually, if you dabble in these very high volatility digital assets, keep it a really small slice of your portfolio, maybe 1% to 5% max.
Good advice. And one more warning, what about using stablecoins to store wealth long term?
Yeah, you need to be careful there. Stablecoins are great tools for, transactions, moving money around efficiently in the crypto space. Yeah. But as a place to store wealth, not so effective. First, there's issuer risk. You're trusting the company behind the coin. And critically, they generally don't pay you any interest.
Right. That's a big opportunity cost.
Huge. Especially now. With U.S. interest rates sitting around, 4.5% to 5%? If you hold $1 million in stablecoins, you're essentially giving up $45,000 to $50,000 in interest income every single year. That lost opportunity makes them pretty unsuitable for just parking long-term wealth.
Okay, we've covered how to build and protect wealth. Let's zoom out to the really long-term picture, family wealth, personal finance basics. The focus here seems to shift, doesn't it? From just assets to passing on wisdom.
It really does. And it starts with the absolute fundamentals,
Right.
saving and having liquidity. Dalio suggests everyone should figure out, how many months could you live your current lifestyle if your income stopped tomorrow? And then he says basically double that number for a real emergency fund. That 6 to 12 months of expenses needs to be somewhere safe and easily accessible.
And that need for liquidity highlights why just saving cash, while necessary for emergencies, isn't enough for the long haul, because inflation is always chipping away.
It's that invisible tax, always working against you. Even if inflation is only 3% a year, which sounds low, that still cuts your purchasing power in half in about 24 years.
Yeah.
So you have to invest even conservatively just to stay level in real terms, let alone grow your wealth.
Which loops back to Dalio's big point about inheritance, doesn't it? His emphasis isn't just on handing over money, but on financial knowledge education, empowering the next generation slowly.
Absolutely. That's the critical legacy. The real goal isn't just dropping a pile of cash on your heirs. It's transferring the skills and the mindset to manage wealth successfully. That means teaching investment principles, risk management, understanding compounding, and crucially, that discipline we talked about earlier, avoiding emotional mistakes. Passing on those principles, that's worth far more in the long run than just passing on dollars.
This whole deep dive has really been a masterclass in thinking systematically with discipline.
Yeah, if you boil it all down, maybe it's three core ideas. One, diversification done right with uncorrelated assets, that's your free lunch. Two, cash is risky long-term because of inflation. And three, your own behavior is key. Discipline, through things like systematic rebalancing, has to beat emotion.
So just to give our listener a concrete starting point, what might a basic Dalio-inspired neutral portfolio look like? Just
Right.
ballpark figures.
Sure. And look, this always needs tailoring to your all-specific situation, your risk tolerance, your timeline. But a typical starting point, a neutral allocation, might be something like maybe 30% in global stocks for growth, then perhaps 40% in globally diversified bonds, different types, different durations to hedge that growth risk. Then maybe 15% or so in hard assets like gold and maybe some commodities to hedge against inflation and geopolitical shocks. The rest might be split between some alternatives in your necessary cash liquidity buffer. But again, the exact percentages aren't magic. It's about achieving and maintaining that balance across different economic drivers.
Fascinating stuff. Okay, now for you, the learner, listening in, here's that final provocative thought to chew on. Given Dalio's laser focus on global balance, and we see the dollar share clearly shrinking, and we have these massive trends like AI revolutionizing things and the world becoming more multipolar, what single economic indicator are you watching right now? Maybe one that most people are ignoring that might just signal the next really big shift in where global assets are headed. Thinking about those kinds of second-order effects, that's where real insight comes from.